here's the day after the election, and we've just basically given all that back up.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you back here at the end of another week, featuring my good friend, the pugilistic Lance Roberts. Lance, how you doing?
Why are we fighting today? What's up?
Well, it's a little bit of a nod to your background as a mixed martial art fighter, but
Yep.
but also you've been throwing some swings at some big names, Paul Tudor Jones, Jim Grant. I could see you were sort of in the fighting spirit. So we're going to talk at some point in this discussion, I'm sure, about the recent piece you just put out responding to Paul Tudor Jones. So I wanted to set the stage early.
All right, there you go. All right, yeah. Well, that, and then of course tonight is the Tyson Paul fight. So
Oh, is that tonight?
it's age versus experience. It's it's gonna be a very interesting thing. I saw some stuff on social media that maybe the fight is kind of fixed for Paul to win. There were like some pre-printed headlines that got released. I don't know if any of this is true, but I'm rooting for Tyson. I want Tyson to win, but we'll see what happens tonight. I can't wait.
All right. Well, I guess by the time people are watching this, they'll know the outcome.
Yeah. Absolutely.
All right. Well, look, we got a lot to talk about. Real quick, I just want to give a nod to an important topic I think everybody watching should at least have on their radars, which is end of year planning. There's a lot of steps that you can take and should consider taking before we roll into the new calendar year. This is where a good financial advisor can come in real handy. But even if you're a DIY investor, there's a lot of steps that you should be looking at. I just sent an 18-point checklist to all my Substack subscribers. So if you are not yet a Substack subscriber, you can sign up for free. Highly recommend everybody go get that checklist. I also want to give a nod to the fact that from RIA, from your firm, Lance, we're going to have Danny and Richard. Next week, I'm going to be recording a session with them dedicated to end of year planning. So folks will have that on the channel at some point, probably within a week or so of you watching this video. So keep your eye out for that. But again, the important thing about end of year planning is you got to get it done before the end of the year. And we don't really have that much time left. I mean, we're just about in Thanksgiving, before you know it, with family visits and holiday shopping and everything else. The winter holidays are going to be here before you know it. And most people, this better than anybody, Lance, have the best of intentions to do it, and then they just don't because time sneaks up on them, right?
No, it's absolutely right. And again, this is the time of year for tax loss harvesting, and look, mutual funds, professional managers, they're all going to be doing the same thing here soon. Getting ready for the because you have to have certain things done for the tax year. For reporting purposes, and same thing applies to you as an individual investor. This, one of the mistakes that we make is like, oh, I don't want to sell that because it's at a loss, and I don't want to recognize the loss. Yeah, recognize that loss because you can write those losses off in the future. It's not working for a reason, and so now we can set those losses off against some gains. You do a little bit of harvesting on both sides of the portfolio, rebalance it for the end of the year, and that's just good, healthy maintenance.
Yeah, exactly. And look, a lot of people are probably sitting on some pretty good gains here from 2024. Like, don't fumble the ball on the goal line, right?
Yeah.
Like, make sure you end the game strong. If 2024 wasn't a great year for you, all right, well then, reassess and set yourself up to maximize your odds for 2025, right? So anyways, something everybody should do, like I said, go get that 18-point checklist on Substack. And if you're there, and again, I gave the big spiel last time, but if you want to support this channel, a really important way to do that, really helpful way to do that is to upgrade to the premium version of Substack. I think you get an overwhelming amount of value for the price. And just a reminder too, if you've been thinking about doing it, do it soon, do it before the end of the year, because the price is going to go up from $15 a month to $19 a month by the end of the month, by the end of the year. But anybody who signs up beforehand will be grandfathered in at the current $15 price. And if you're an existing premium subscriber, whatever price you're paying per month, that's not going to change. You're going to get grandfathered in at whatever you signed up for. So you folks that are getting $8 a month are getting a really good deal. All right. Well, let's talk about the week, Lance. Been a little bit more volatile of a week than we've had in the past. Not a surprise to you.
Yep.
So, couple things. One, congrats. You had said that you'd said at Target, I think, pretty early on this year that the S&P could rise to 6,000. It has. It's pulled back a little bit. I think you've also said that you expect, for a bunch of reasons we've talked about in the past, seasonal reasons, programmatic reasons, rebalancing reasons on the portfolios from professional investors. You can see pretty good reason that stocks could still continue to run even higher into the end of the year. Are you still thinking that based upon the recent action?
Yeah, no, absolutely. And what's happening this week is we wrote about this quite a bit over the past week, and on our daily market commentary that we put on our Substack channel is a good kind of process to follow, because every day we kind of review the market, where it is, kind of what to expect. And we had written about previously is that going into Thanksgiving, you should expect some weakness in the markets. Traders are leaving for the holidays. A lot of traders already gone. They won't be back until after Thanksgiving. So volume is drying up. We've had a big run post the election. Everybody was very exuberant in the election. Everybody kind of went all in into the markets. And so you should expect, we have very deviated from the 50-day moving average. So just expect a bit of a pullback here. Post Thanksgiving, we're going to get a little bit of a rally. That rally will last about a week to 10 days. And then in the first, really kind of the second and third weeks of December, we're going to get another sell-off in the markets, usually, because mutual funds go through their annual distribution. So every mutual fund and every portfolio manager, hedge fund, et cetera, they have to distribute their capital gains, interest, and dividends for the year, which requires them to sell assets to do that. So expect a little bit of weakness, a little bit of volatility going into Christmas. Then post-Christmas, we're going to get the window dressing for the end of the year, because every manager wants to be long stocks, and they have to be fully allocated by year end anyway. And they want to make sure they hold the right stocks for reporting purposes. And so that's why you always have that kind of 5 days into the end of the year. And then the first 5 days of January is kind of the rollover of that, as investors get positioned for the new year for tax reasons. I can buy everything I want at the beginning of the year, and I've got a full year before I have to pay taxes on it. So expect some volatility here between now and the end of the year, but markets will probably, and then don't really look at Friday's action at all. We've got a huge OPEX going on. It's the largest OPEX in history for options expiration in history for the markets for November. So again, there's a lot of volatility, positioning going on today on Friday, so I wouldn't worry too much about that. But again, post Thanksgiving, I would look for a bit of a rally here.
Okay. So we'll get to your trades, obviously, near the end of this conversation, but you're not surprised by anything you're seeing right now. Are you making many changes or making many transactions? Okay, no. So you're kind of steady the course is where you guys are.
And we can just do trades now because it's only two. We've owned AbbVie for a long time. We've owned AbbVie for many, many years. Pays a big dividend, fundamentally very strong. The stock got hit last week because of a phase 2 trial of a schizophrenia drug that they were working on. Stock took about a 12%, about a 13, 14% hit on that news. And so we basically just used that opportunity. It's had a huge run. We used that opportunity to kind of just build our position back up to target weights. And then we also, so we bought that, and then we also added a very small position in IWM, just simply because small and mid cap should perform better since the election of Trump. One thing you'll want to watch there's a very high correlation between the National Federation of Independent Small Business Confidence Index and small cap stocks. And you're about to see that index for the NFIB literally explode. In the next report that we'll get for November, you're going to see that index rise extremely sharply. You're going to see the optimism just surge in that index. Same thing we saw with the New York index today as well. That's because most business owners, manufacturers, they tend to lean very conservative in terms of their political views. And that index, and again, you kind of see this with the National Federation of Independent Business Index. It's been very depressed for the last 4 years. It's been at some of the lowest levels ever in its recorded history. under the previous administration because of threats of higher taxes, because of regulations, because of things that were going on that don't necessarily work well for business owners. Business owners, as we've talked about before on the show, it have to be optimistic. If you're going to own a business, you have to be optimistic. And that optimism's really been pressed by a lot of the political regulations and policies that were put in place over the last 4 years. So the idea of an extension of the Tax Cuts and Jobs Acts from 2017, potentially even lower corporate tax rates for them, less regulation from the government on their businesses. That's why they tend to lean conservative in terms of their political views. And so what you'll see now is with the election of the Trump administration and a lot of these people that he's putting in place for different departments of government, those are all very pro-business friendly. So you're about to see that index just absolutely surge. Well, that year-over-year rate of change is going to help support small business growth because they're going to be more willing to do CapEx, make investments, expend money to hire employment, raise wages. So all that's going to be very beneficial to small caps. So small cap and mid cap should start to perform better. So we added a very, very small percent starter position in IWM. And we're hoping to get this pullback we're getting now, and then we'll be able to build out the rest of that position as we head to the end of the year.
Okay. So totally understand that logic. And small caps have done really poorly for the past bunch of years. So I'm sure that's if indeed your prediction proves true, that's going to be very welcome to that sector. Let me ask you this: if indeed that happens, do you see that as a rotation? Do you think it'll happen in part due to a rotation out of the sectors that have overperformed, like big growth tech, or is this just going to be the smaller caps rising up to join the party that the larger caps have been having?
Basically, the small caps will just kind of rise in kind of unison with the markets. If you have to take a look at the regulations that are coming down the pipeline, this can be very beneficial for technology, artificial intelligence. So those large caps are going to continue to perform very well. You cut taxes. One of the policies that Trump is talking about, which could be super beneficial to the economy, is capping credit card interest at 10%. So, it's interesting, Adam, if I loan you money and I charge you a 25% interest rate, that's called usury in every state in the union. And so if you don't pay me back my loan and I take you to court, that contract is going to get thrown out to be invalid because I charged you at what's called a usurious interest rate. I was taking advantage of you, so it invalidates the contract. But yet credit card companies charge people 20, 25% interest all the time, and this is okay. But that's been a huge burden on consumers because every time they're paying their credit card debt, that interest rate is so high that they never get out of the principal payment. They're just paying interest, and they're trapped in these credit card debt cycles for 40 years. But this idea of if he can get this passed ultimately and get this done, lowering that interest rate to 10% on credit cards could be a huge boon for consumers. So companies like Amazon, Walmart, Costco, those will do better. Any the kind of the discretionary spending side of the ledger would do a lot better in that type of environment. So there's quite a few very, very again, look, it's all dependent on if these regulations get passed. There's no guarantee it will. There's huge headwinds in terms of politics still, in the system. But some of these policies could be very pro-economic and pro-growth friendly for the economy, and that would certainly help, that sector in particular.
That's interesting. I hadn't heard that one, and I get your logic there. Let me just ask you this, and this is just real-time reaction to the idea. Look, I've got no love for the credit card companies. I don't think anybody does, right? And what they charge is crazy. It's ridiculous, right? But let's assume for a second that this goes through, right? Okay, if you got a credit card, you're not going to get charged more than 10% for it, right? Every consumer will cheer that and love that who has a credit card. My question is there's a lot of Americans that aren't great credit risks, right? And they're probably not worth, let me put it this way, at a 10% cap, I imagine credit card companies are going to look at, their book of business and say, well, I got to lop off this part of the tail because these people just aren't worth the risk. And I wonder, what the unintended consequences of that would be, both in terms of those people, a lot of them just, as we talk about, they just live on that credit to get by, right? Just to literally put food on the table. And I wonder, would we see enough? What would the net difference be on consumer spending? Would it be enough of a boost to make it rise, or would so many people who are currently living on the plastic who wouldn't be able to anymore, would that be a net decrease in consumer spending? I don't know.
Well, it could work a couple ways. So first of all, let's look at it from the angle of I'm the credit card company, right? So first of all, I've got 1 million credit card debtors that owe me money. Well, if all of a sudden I can't, so first of all, 10% is a pretty decent return of interest, even on a higher risk creditor. But just assume that, at this juncture, I've got a whole bunch of people that are sub 600 credit. Well, I'm certainly not going to extend them any more credit at this point. I can't go to them and force them into default immediately. Now, if they're already in default, that's a different story. I could be more aggressive about trying to do collection at that point. But again, collections are very, kind of a no-win situation. And what happens with most of these credit card companies is that I wind up just writing that debt off,
Right.
send it to a credit card collection agency that just hounds people into the end of the world trying to collect whatever. They buy it for cents on the dollar, then they try to collect on it. What they can't collect on, they then sell to another credit card agency at debts on the, cents on the dollar of that, and it just kind of keeps going down the mountain until they hopefully get every little last cent they can collect out of it. But as a credit card company, there is a negative impact to this, which is all of a sudden they become much more prudent about who they give credit card debt to, which would actually be a good thing long term. This is, and by the way, this is something that I said we talked about a lot this week on the radio show, and had a lot of conversations about this. Is that, look, we didn't get into the financial situation that we're in this country: debts, deficits, credit card debt, corporate debt, consumer debt, you name it. We didn't get into that process overnight, and we're not going to get out of it overnight either.
Mm-hmm.
And all the and while a lot of these policies that Trump is talking about doing will be very good long term, you're not going to get those long term economic benefits pain free. And there's a real risk.
You may remember I asked you about this last week, and then I've been asking everybody that I've been interviewing since about this. So trust me, we're going to talk more about this. Keep going.
Yeah. But that's the point. So I mean, if all of a sudden you start, credit card companies go, whoa, at 10%, I'm only going to give credit to my higher credit score consumers. All of a sudden, there's going to be a lot of consumers that don't have access to credit. Now, again, they're going to be paying. It's going to be easier for them to pay off the credit they have, but they're going to have a real tough time getting new credit. All of a sudden, you're going to probably start seeing, subprime auto loans go away, those type of things. So, again, that's going to cause an economic, decline in the short term. Now, long term, it'll be great because we'll clean up the balance sheets for a lot of households. We'll get them into a lot better position. But, over the course of a couple of years, getting through that process, it could certainly lead to an economic recession.
Yeah. So this is a drum I think, Lance, we're going to keep beating for a while here. And one of the things that we discussed last week that I believe really is should be a huge priority for the Trump incoming administration, is they need to start communicating that. Yep. Right. Hey, look, just like, getting over any addiction, right? You got to get off the juice, but you're going to have periods of withdrawal, right? You're going to get to a better place, but you got to take your medicine along the way, right? So I think they really need to get out ahead of that, because again, right now, as we talked about, the campaign promises were all sunshine and roses, and hopefully they get there. And I wish them the best of luck on getting to that stage. But you and I, being realists, say, look, it's going to take a lot of pain between now and then. All right, so kind of on this thread related to this, so we had some retail sales numbers that came out today, and they were kind of spotty, right? Where did I have it here? A hot headline number, cool core number, and an ugly control group. And I know there's a lot of seasonal adjusting going on there, but one of the questions that this raised was, here's a quote: "It's almost as if they wanted to make the numbers look bad on purpose." And I mentioned this to you, I think a couple of times, Lance, that, should Trump win, the Biden administration would probably say, all right, well, look, we've been doing everything we can to kind of hold this thing together, right? We've been throwing the kitchen sink to make the economy look as good as possible. a lot of accusations. They've been burnishing all the BLS numbers to look as good as possible. And then now that the torch is going to Trump, we're not doing any more of this. Screw it, right? And maybe we're starting to see a little bit of that. And to be honest, I think Trump wants that. I think he wants to be able to say, look, I inherited this steaming pile from the previous administration, and you guys are lucky to have me. I'm going to fix it, but it's going to take me a while, and I get to spend the first 2 years of my administration, especially while we're getting the painful medicine that he wants to bring in. And he can just blame all of that pain on the previous administration and say, we wouldn't be here if it weren't for them, but thank goodness I'm out here doing the repair work, right? So I'm just, do you think we're beginning to see some of that?
Yeah, there's always been conspiracy theories about the economic data, and to be honest, I don't know whether it's manipulated or not. I mean, there's certainly, things that we see from time to time that goes, that kind of looks suspicious. But at the end of the day, you got a bunch of humans that are using really outdated methods of calculating economic data. For instance, a good example is these surveys that we do. For instance, talking about CPI this week, right? So CPI came in, right on the screws in terms of both the headline and the core, exactly what was expected. There was an uptick in homeowners equivalent rent. So everybody immediately jumped on that. And they say, see, housing inflation, it's still there. Now, look, housing inflation is very important. That's 44% of the index. So, that's a very important number. Now, over the last 5 months, homeowners equivalent rent has come down, but it did tick up last month. And so everybody's like, well, there's the data. But the problem with the homeowners equivalent rent, it's a very flawed measure in terms of the way they calculate it, because every other measure of real-time rent is basically zero. There is no inflation in real-time rents. I can give you a real-time story about rent as a good example. That for the last, couple of years before where I am now, I was renting a house. So we rented the house in July 2 years ago. So we're actually about 2.5 years forward now. We had a contract for 2 years to rent that house. So my rent never changed for 2 years. Now, everybody else is saying, well, rent's going up. My rent didn't change for 2 years. Now, the interesting thing is that when my rent contract terminated, the homeowner tried to raise the rent. Now, this is in a really desirable neighborhood in Houston. This is a neighborhood that's very centrally located. If a house goes up for sale, it's immediately sold. Houses don't stay on the market for more than a day because everybody wants to live in this neighborhood because it's very close to good schools, private schools, all kinds of stuff, very centrally located to shopping and eating and all these type of things.
Right. And the Robertses are like the Rockefellers. I mean, they're not going to live anywhere but a palace. Yeah, no, I get it.
Exactly. Right. So this is, yeah. But anyway, so he tries to raise the rent. No luck, no takers. Held the house on the market for 2 months at a higher rent. Finally wound up leasing the house in the 3rd month for less rent than what he was charging me for the last 2 years. So that's the problem with homeowners equivalent rent, is that it's all an assumption. Here's how homeowners equivalent works. They call people up on a survey and say, Mr. Homeowner, if you were going to rent your house, what could you rent your house for? Well, I know what my mortgage payment is. Well, I don't have a mortgage payment, but if you know what your mortgage payment is, you're going to go, well, my mortgage payment's $3,000 a month or whatever the number is, and I need to stick on a little bit more for taxes and insurance and blah blah blah. So $3,500. Or if I just and again, we're seeing this number kind of change every month, and so there's been no housing sales for the last couple of years. I mean, basically, when we talk about housing sales and home price appreciation, you're talking about the sale of 1 or 2 houses for the most part. It's a very, very low number of houses that are being transacted. So you're seeing these kind of big outsized moves. And so they impute, this is why they call it imputed rent. They're imputing this data on, a short-term basis into the overall market, saying, oh, that's what the rent is doing. However, most people sign rental contracts for 18 months. So their rent doesn't change for 18 months. So these variabilities in these economic data points are so flawed. When we have real-time data, like we have Redfin, we've got Zillow, we've got real-time data for rent. That's all the Fed needs to look at, or the government, and hopefully, maybe Vivek Ramaswamy and Elon Musk will figure this out and just get rid of all these government employees, because we have plenty of real-time economic data for the Bureau of Labor Statistics and the Bureau of Economic Analysis. We really don't need them anymore. We can save a lot of money. But there is no rent inflation. But again, it's flawed because of the way that it goes into the CPI calculation, and that lag is probably 18 to 24 months that's still catching up on rent. So rents are still going to go down. It's just going to take another 12 months for us to get there.
Right. And I think, and we're going to talk about inflation in a second too, but I think part of it is we're beginning to have the big spikes roll off of the year-over-year measure, right? Recently, the disinflationary impulse looked huge because you were starting at 9%. Now that's very quickly ratcheting down. So the year-over-year differentials are not looking as impressive.
Right. And that's another thing too, is that
Yep.
that's a very good point, is inflation in April. If CPI keeps printing at 2%, 0.02% a month, as it just did, if it does that for the next 3 months, inflation CPI will be 1.9% in April. And that's because of the year-over-year comparison number. So, I mean, we can actually pinpoint exactly when we'll be below the Fed's 2% target. And that 2% target is very important, because it's really, and by the way, it's not really 2%, it's actually 2.4% is the Fed's target. They just round down. And if you want to know how they actually get to that number, it's because, here, let me share my screen real quick. This is how they get to that 2% target. This blue line, this dashed blue line, is what you get if you average CPI out over the last, since 1993. So you take all the data from 1993 to present on inflation, and you just take an average, and that's 2.4%. So that's how the Fed gets that. So if I do 0.02 every month, what's 0.02 times 12 months? It's 2.4%. That's the average inflation rate of CPI going back to 1993. So that's why if you've ever wondered, why is it when they do the estimate for CPI, every month it's 0.2, every month. It's never we think it'll be 0.3 this month, or we'll think it'll be 0. It's always 0.2, and that's because that's the average. So again, so if we just do that 0.2 every single month, we'll be at 1.9% because of that year-over-year comparison in inflation. But this is inflation actually broken down by category and the weights. So you can see that housing makes up 44%. Inflation, it doesn't matter what every other component in inflation does for the most part. It's all housing that drives the inflation number at the end of the day. And so it came in at 12.56. It's down from 13 in June. And there's always been some variability. We went from 13 to 12.8 to 12.9 to 12.2 to 12.5. This is and rent doesn't do that, right? That's my whole point. Rent does not jump around month to month because rental contracts are fixed. It's the same thing for healthcare. We've got medical care jumping around all over the place, but medical care is fixed. I signed my insurance contract, and everybody's in open enrollment right now. So you sign your contract for healthcare. Your costs are going to go up this year because it's open enrollment. And then in March, once your insurance becomes active, your insurance payment's the same every month for the rest of the year.
Yep.
Right. So that's the problem with all these numbers. And we put way too much weight on these numbers, going, oh my gosh, this is this, or this is that, or it's all manipulated. No, it's really that there's just a crap ton of just guesses and manipulations and bad data and bad analysis and bad methodology that's been in place for the last 50 years, and they just haven't changed it.
Okay, so this is a good segue into what I want to talk about here. So what I'm trying to do is get to your rebuttal of Paul Tudor Jones, and a lot of his aversion to bonds has to do with thinking inflation is going to be secularly elevated going forward, and you have a different opinion on inflation. You've just sort of been explaining why. First, I just want to make a concluding point on what we're talking about, which is I'm with you, Lance. I mean, I think that there's all sorts of data collection issues that make this more challenging. I do also think human nature being what it is and political nature being what it is, I think it's an and, not an or. I think there's there's questionable data, and I think there's been a lot of attempts to just, try to, the status quo was doing everything it could to protect itself. Now it happened to just lose. So we're going to see what happens going forward. Also, on a related note, I was talking with Melody Wright. I just interviewed her, housing market analyst, and folks, that interview's coming out, I think, on this coming Tuesday. But she has spent her career in the mortgage industry, and I think you'll be hard pressed to find a greater critic of the industry and how it operates. But one of the things that she mentioned is just the unbelievable level of archaicness in terms of the information systems that the industry uses. Like, she's like, there's still people that are basically using green screens, like DOS, for a lot of this data. And she's like, so much of this data is hard to get, takes forever to compile. People are using these incredibly anachronistic systems. And she's like, there's no reason for this, especially in this modern era. So hopefully some of this, DOGE, Department of Government Efficiency work, really does focus on information systems, because there's a lot, I've heard this in a lot of other industries, that we'd be shocked to know that, some of our most important industries are run on like 1970s or sometimes late 60s technology. Just the efficiency that could be unlocked by that could be tremendous, I think. So anyways, more on that at a later date. Okay, so we're getting to your point on Paul Tudor Jones. Just very quickly, you mentioned we got the new inflation data this week. Powell was interviewed about it. And I know you say not to put too much emphasis on, the headlines and all the talking points around inflation. But I just think it's important to note that Powell, kind of did say, hey, look, I'm not under any pressure to bring rates down. He was like, look, if I got to keep them higher because inflation's sticky, I will. He's like, I still think, I'm like you, Lance. He's like, I'm still confident we're going to get to our 2% target. I'm not changing my mind on that at all. But if I got to pause for, a couple months or whatever, like, I'm happy doing that. So anyways, I think, who knows, is any of market's reactions since that to his comments, or is it all about the massive, infinite witching hour, we have this in this today's record stuff? Who knows? But it's important to note, at least, that Powell is at least sending the signals. I'm not going to be pressured into this.
Well, no, and look, I told you up front that he should have only done 25 basis points back in September. There was really no reason to opt for the 50 basis point cut, so he kind of put himself in a box. But again, inflation is coming down. It's just coming down slowly, as you would expect it would. There is still just a ton of financial liquidity running through the system. And that's just going to take a while to work out of the system. And everybody's expecting this kind of just this reversion to the mean to happen overnight. And it just doesn't work that way. So it's just going to take longer for them to get there. As I said, just if we keep printing 0.2% a month, he'll be at his target in April. But if you get a couple of hot prints in there because of, oil prices spiking or whatever, well, it might be May, might be June before you get there. But it's going to get there eventually. It's just a function of time. And as and one thing that is still runs with about a 3-month lag is oil prices. So this decline in oil prices that we've had over the last several months is going to continue to weigh in. We had talked about previously that oil was extremely overbought earlier this year, that you were going to get a decent correction in oil, and that's been occurring, and you're now starting to see, because of that dollar spike. We talked about gold being exceptionally overbought, and that all it needed was a catalyst to do that. And the election of Trump has now caused the dollar surge to rise to a level that central banks don't need to hold as much gold reserves. So you're getting a lot of liquidation of excess gold reserves because that's just basically, gold's just, all it is a proxy for US dollar reserves. I can either be in treasury bonds or gold. So they're liquidating, some of those whole excess holdings because of the dollar surge. And if economic policies continue, or the expectation of those economic policies are going to be pro-dollar, specific, that's going to continue to weigh on both oil and gold prices, commodities in general, because of a stronger dollar.
Okay, and I do want to talk about the dollar in a bit too, but now I think is the right time to head over into the world of bonds.
Okay.
So, I hate to keep asking about this every week, but every week that bond yields go up, more people are sweating bullets, and they need
I don't understand why. Look,
because people are human.
Right, but what does it matter? So if you look, if you own bonds, what does it matter if interest rates go up or down in a given week?
Right. It
Right?
shouldn't. And let me just interject here with the whole Stephen Bavaria. Your bond portfolio should be looked at as the income factory, right? Ford doesn't care what the value, the market value of its factory is on any given day. It's just wondering how many cars is this thing producing, right? So how much income is your bond portfolio producing? Is it producing what you need? Great, you're fine. Don't worry about the day-to-day price fluctuations.
Well, it's not even that, but the drivers of what drives bond prices long term doesn't change in a week. It doesn't change in a month. It doesn't change in a quarter. These things take these take a long time to make changes. And in the short term, you've got a lot of trading action. So if interest rates are going up or down in a given week, that's just traders, right? That's just bond traders in the market buying, selling, shorting, doing whatever they're doing to hedge their book, for whatever their positions are. A good example is that um, and I may have explained this before, and you can stop me if I've explained this before, but there's 20 primary dealers that go to auction when the Treasury issues debt. Have I told you this before?
I think we've talked about it, but not recently. And just a note, those primary dealers have to buy at auction. It's not even an option. They
Yeah,
have
it's
to.
not an option. So so if I'm a primary dealer for bonds, so I'm JP Morgan, right? The Treasury says, hey, we need to issue $100 billion in debt. I have to go to auction. I have to buy them. But I'm JP Morgan. I'm Goldman Sachs. I'm UBS. I am any of the 20 primary dealers. What could I do in theory if I know a 10-year bond auction is coming up next week? What could I do to improve my pricing so that when I buy the bonds from the Treasury, then I can then turn around and sell them to my clients at a better price? What could I do? Oh, I could short the living crap out of bonds for a week, drive interest rates up, bond prices down. So when I go to auction, I can buy those bonds cheaper. And that's what you see almost every time going into auction. You'll see rates go up, you'll see bond prices come down, and immediately after the auction, those things will reverse.
Can I
Because,
ask, is
yeah,
that not illegal? And if
no,
so, how? How is it
it's
not
not,
illegal?
it's not illegal at all. Why is it illegal? Right? All I'm doing is I'm kind of controlling the price of the outcome.
Well, I know. I mean, you're taking advantage of the government, which,
Well,
in
I mean, no,
theory,
I'm not taking advantage of the government. I'm utilizing the market to my advantage. Look, how many times has JP Morgan gotten slapped for manipulating the gold and the silver market?
oh, I mean, all the time.
Yeah.
But the government doesn't really care about that, not nearly as much as it does the treasury market. Yeah.
Well, yeah. But again, but the government doesn't really care because you're not talking about big moves in bond prices. You're just talking about, 50 basis points, 30 basis points, 20 basis points, whatever it is. But these are giving these primary dealers have the ability to manage this. So that's my point, though, is that these variations that occur on a day-to-day or week-to-week basis have very little to do with the actual value of bonds, right? And what bonds actually represent, which bonds are just simply a function of economic growth, wages, and inflation. So if you are an anti-bond person, right, which is okay, it's look, you got to have two sides to every market. So if you believe that interest rates are going to go substantially higher from here, you have to make the case for very strong economic growth, very high rates of employment within the country. So you're talking about, kind of a 3% unemployment rate, very strong wage growth, and which would in turn lead to a lot of economic activity within the economy. So people are buying a lot of stuff, which would bring inflation up. If those things are all rising because you have a very, very strong economy, well, then I've got businesses that are now demanding loans from the bank. The bank says, well, I've got a lot of loan demand, so interest rates need to come up because I've got a lot of loans. And so if you can make that case, yes, inflation and interest rates will be higher than they are now. So, but you're talking about 7-8% nominal GDP growth, which would get you somewhere north of 4% inflation. You'd need about 5.5%, 5 to 5.5% wage growth, which would get you interest rates somewhere around 4.5, maybe 5%.
I mean, that's not
That,
even a red hot economy. That's like a white hot economy.
well, no, but no, we've had that economy before. Remember back in early 2000, interest rates were normalizing around 4.5%,
But
5%.
were we growing at 7 and 8% GDP with wage inflation of
We had
5%?
we had much stronger rates of economic growth
Okay.
back at the right at the turn of the century than we have today.
Okay. All I'm just saying is that,
And again, go back 40 years, back to the 80s, and look at where your economic growth was. We were averaging 8% real GDP growth back in the late 70s and early 80s. So, you've got, so the point is that interest rates reflect economic growth, wages, and inflation, right? And so, my outlook is that because of the debt, because of the deficits, we can't sustain higher rates because of the debts and the deficits. Therefore, economic growth is going to be slower because debts erode economic productivity by diverting capital from productive investments.
right.
As capital gets diverted from productive investments, that's less consumption demand on businesses. So businesses produce less and they can sell those products at less cost, which means that you have lower wage growth, which suppresses inflation and interest rates. So,
Yep.
that's the thesis you've got to work out in your own mind as to what your outlook is, and what happens on a day-to-day, week-to-week is irrelevant.
Okay. So I totally get that. And again, it's good that we talk about this to make sure that people that are nervous understand, reality.
Well, look, if you're nervous, sell your bonds. You don't have to own bonds. There's nothing that says you have to own bonds. If I run a 100% equity portfolio, I don't own any, which I do. I don't own any bonds in it.
Well, you run an 100% equity portfolio. You run others as well. Yes.
We run several actually all equity portfolios,
Yeah.
but don't own bonds. If the first rule of investing is that if you're not sleeping at night, stop it. Right? No investment should be keeping you up at night for any reason, whatever it is. If you're losing sleep over it, if it's dominating your daily thought process, if it's just ruining your life, sell it. It doesn't matter what the outlook for it is. Sell it. Get it out of your life. Live your life. Be happy. Money is not that important. So if bonds are basically destroying your life, sell them. You don't need them. There's other assets that you can own, and stop worrying about it. Right? Just turn this channel off and go live your life and do something else, because it just doesn't. It's not going to matter at the end of the day.
Okay, that's healthy advice about any asset class. Here about bonds, though. You again are reiterating, and this is why I'm giving the chance to do so, that you are not deviating from your expectations and your strategy for why you are in the bond trade that you're in. Let's contrast that with Paul Tudor Jones. What specific bones do you have to pick with his outlook?
Oh, well, so Paul Tudor Jones did this interview on CNBC, and he was talking about, government debt and all these type of things. And basically, I'm just going to read to you the first paragraph from the article. Paul Tudor Jones recently voiced concerns that rising U.S. deficits and debt and increasing interest rates could lead to a fiscal crisis. The perspective reflects the longstanding fear that sustained borrowing will trigger inflation, raise interest rates, and eventually overwhelm government's ability to manage its debt obligation. In short, his thesis is that interest rates will rise as the government goes broke. However, again, this is, the problem with his view is that it's entirely wrong. And there's one simple factor is that the government cannot go broke. Period. So that whole fear, his whole argument was hinging on this idea that the government would go broke. It can't go broke because it can issue its own currency and it can issue its own debt obligations. He then went further and undermined his own argument by comparing it to Japan. And we can talk about that as well.
Yeah, talk about it right now.
Okay. Well, so first, let's and as always, look, I just don't make this stuff up. And this is why we back it up with a lot of research and data.
And by the way, again, this is why we have markets, right? You can get smart people who look at the same data and come to different conclusions. And big part of this channel is just to let different sides make their argument. I let you update every week here. We had Luke Roman on not that long ago, who I would say he's on the Paul Tudor Jones team, right? So, we want people to understand both arguments so that they can decide for themselves.
Yeah, the problem though is that, everybody that's on the Paul Tudor Jones team is they don't actually look at data. for whatever reason. I don't know why. But this is a very long-term chart of interest rates and inflation, GDP, going back to
And by the
basically.
way, this is tiny, Lance. So you're going to have to zoom in on this.
Well, let me see if I can figure this out. Is that better?
It is better, yeah. And you might have to zoom in on one half and then move to the other half if you're going to
Okay.
talk about both.
Well, I'm not going to talk about it's the picture in general that's important. And again, so if you go to our website, realinvestmentadvice.com, or go to Substack at Lance Roberts, this article is posted in both places. So all this data is there for you. But what this is data, this is inflation data and GDP going all the way back to 1854. And what you'll notice is that outside the one spike that we had in the 70s in terms of interest rates and inflation, everywhere else in history, it's been on a steady decline. And the reason for that is ultimately because there were kind of three specific points in history where we had the ability to create actual inflation and economic growth. You had the economic inflationary spike in the early 1860s, and this is back when we were primarily an agrarian culture, lots of recessions kind of rolling back and forth, but we were just kind of starting to head into that beginning phase of the Industrial Revolution that led us into the 1920s. Then you had the golden age from 1900 to 1929, and that was where you just had an explosion of productivity, manufacturing. Ford created the auto manufacturing plant. We had cars. I mean, we were just firing on all cylinders. Well, that created a tremendous amount of economic growth and gave us that inflationary push because people were literally making money hand over fist. You just had this economy that was just literally booming at every single corner, building railroads, traversing across the country. I mean, it was just a terrific time. And then, of course, 1929, it all kind of blew up, and we went through the Depression, went through World War II, and interest rates fell during that period. Inflation fell. And then coming out of World War II, we went into another one of these periods where it was basically economic nirvana. We had all these for the entire time of the war and coming out of the Depression, there was not a lot of purchasing going on, and you couldn't purchase anything during the war. Everything was on ration because we were building everything for the war effort. So the average American, they couldn't buy a whole lot of stuff. They were rationed on cheese and tires and you name it. But coming after the war was over, all the soldiers come back home, and all of a sudden we're making babies and building houses and starting businesses. And oh, by the way, we had bombed basically every manufacturing center in the entire world into oblivion. So the U.S. is now the manufacturing epicenter of the entire world, and we're rebuilding Japan and Germany and Europe in general. And that output led to very strong economic growth that led to higher wages. And of course, during that period, you had rising inflation and interest rates, which is completely okay, because as long as wages are keeping up with or outpacing inflation, higher prices or inflation is a byproduct of economic demand. So it's all good. And then, of course, we had the oil embargo and the inflation spike, which kind of crippled everything right there at the end. But that was kind of an anomalous event, which we don't have that going on currently. So, in order to get back to that kind of inflationary spike, you're going to need some anomalous event like an oil embargo situation that creates a massive spike in prices without an underlying spike in economic growth and inflation. So fast forward to today, yes, we just got through an inflationary spike. We had an anomalous event. We printed trillions of dollars in liquidity and shut down the economy. So we created inflation by creating an artificial inflation supply, an artificial supply shock to the economy. So we had lots of demand from consumers because they have capital we gave them. They didn't work for it. We just gave them money, and they could go out and buy stuff, but there was nothing to buy because the economy was shut down. So now we're coming out on the other side of this. So now the problem going forward is now you've got all this debt, you've got all this, kind of normalization of the economy back to more normal levels of economic consumption. And all that liquidity is now reversing out of the system. So that's more of a disinflationary pressure going forward, because what people were used to buying, they no longer have the money to buy. In fact, if you take a look at savings rates, those are now starting to turn fairly sharply negative, and that's going to continue that process as we go forward. So again, this is kind of one of the problems that we have, currently with the system. Hold on, I'm having trouble with my graphics. Here we go.
Yeah, and as you're pulling it up, let me ask this question, which you can address in explaining Paul Tudor Jones's side. There's that time-honored saying, the cure for high prices is high prices, right? Inflationary periods end because it gets to a point where just nobody can afford to buy stuff, and then they retract their spending, and then disinflation takes over. I would think you would say, yeah, that's what you're expecting. Why doesn't Paul Tudor Jones expect that?
Well, that's what we're going to get to, and this is, and because his thesis is pinned on really 2 points, which is the government's going broke in Japan, and we're about to get to that. But you were just asking me about real growth in the economy and where we were previously. So this is a chart. So the black line is 10-year interest rates. The red line is an economic composite of wages, GDP, and inflation. So this goes back to 1965. So this incorporates all the 1970s. Now you can see that in the late 1970s, interest rates were spiking because of that inflation spike. But economic growth, wages, and inflation were all growing during that time frame. So going back to 1965, we were growing at 6, 7, 8% in terms of this composite economically. And today we're looking at roughly about 4% growth. So, there's a big difference in terms of where the economy is then versus today. Now, also step back for a moment. Remember, there was no debt back in the 60s and the 70s. My parents didn't have credit card debt, right? There was no credit card debt. They had a mortgage, and that was about it. The average
and the nation had much less debt too. Yeah.
Well, yeah, the average household debt to income was about 60%, including the mortgage. Today, it's about 180%. So again, the problem becomes, again, that debt service. I've got to service that debt. And if I'm having my money that I make on income going out to servicing debt, that's less money I have to spend in the economy. And so that's why since 1980, when and this is all Ronald Reagan's fault, is that in 1980, he deregulated the financial system and allowed banks to become predators on consumers and start issuing out credit cards like crazy. And so we got an entire population addicted to credit card debt, and we increased debt by $11 trillion between 1980 and 2000. That led to a massive consumption surge in the economy. But as we increased debt, we kept generating slower and slower rates of economic growth because we were piling on more and more debt that had to be serviced. And we haven't altered that trend. The only reason that we had this spike in 2020 was because of artificial inputs into the economy that now no longer exist. So if your thesis is that you're going to maintain higher levels of interest rates and inflation, what is your driver for the underlying economic growth if there is no longer any type of government spending into the system in terms of sending checks to households, those type of things? Because this administration isn't talking about that. They're talking about cutting $2 trillion off the deficit in the next 4 years. If they only do 1/4 of that, that's $500 billion of spending that's not going to occur within the system. So
it's anti-stimulus, whatever that is.
Yeah. So where's your stimulus? Where's your support for this boom in economic activity going to come from? So that's and that composite holds true just going all the way back through history. Here's the other thing. So here is just more evidence of the same thing. This is your average economic growth cycle by average economic growth by cycle going all the way back to 1790. So Washington, Fillmore, William McKinley, Wilson, and we go through kind of every president all the way up to Biden. I haven't updated this for Trump yet, obviously. But what you notice is that as debt has increased since 1950, economic growth has continued to slow. And it's not been a shift for the better at any point that more debt makes more growth, but it erodes economic growth over time. And, you'll notice that debt to GDP is actually, and this is one of the other big kind of fallacies, people right now running around waving their arms out. It's like, oh, debt to GDP, it's actually declining, because we've got economic growth right now. And we're not issuing debt at the rate we were back in 2020. But even the high levels of debt to GDP are eroding the ability to grow the economy at a stronger rate. And this is going to continue to be the problem as we go forward. And if we go back and look at that economic composite, there's an 85% correlation between that economic composite and inflation. So if you want to know where interest rates are going, all you need to do is factor in where GDP, wages, and economic growth are going, because there's a super high correlation between all those factors that actually determine the outcome on that. So Tudor's last argument. So first of all, his argument was the government's going broke. I don't want to own bonds because the government's going broke. Government's not going broke. Government can issue its own currency. They can print, and I'm not saying any of this is a good thing. I'm not saying printing currency is a good thing. I'm not saying we should be doing it. I'm just saying, as a function of the idea that the government is going broke and they're not going to be able to pay their debt, it's a false statement. As long as the government can print currency, which we can, they're not going to broke, because all I got to do is print currency to pay a debt. So if a debt comes due and Japan says, hey, here's my 10-year treasury bond, I want my money back. We don't have it over there, but here you go, right? We'll print money.
Yeah. Now and Japan is a great example of this. And I know you're going to Japan in a second here. What pays the price of that supreme ability to always repay your debts, right, is the purchasing power of your currency, right? And Japan, has been really seeing some weakness in its currency over the past several years because of this. Now, the point I want to make is, and look, I'm not trying to criticize a much smarter mind than mine, like Paul Tudor Jones's, but also to your point, Lance. Now, I think he's right in the sense that, like, look, there's a price the U.S. will increasingly have to pay to continue the status quo of its profligacy, but that's not like, oh, whether it goes broke or whether it's just some unavoidable crisis event, it's highly unlikely to happen like next year. That type of crisis, right? He might be right that there is some big reckoning moment the U.S. might have to face if it doesn't change its ways, but it does not seem at all like that's an existential thing that's going to break the system in a quarter, next year, maybe not even in the next decade. So I know one of the things you mention a lot, which I appreciate you keep doing, is for people that get wound up about this, even if he proves to be sort of right on the thesis, you got to be careful about timing. You can't just go hunker in the bunker a decade in advance and hope to, to be okay.
And the other thing too is that, let's just say that he's right, and this profligate spending just continues. That's deflationary. That's not inflationary, because the more debt you have, the more detraction from economic growth you get. This is the basic. And look, if you don't believe me, go ask Lacey Hunt. He'll tell you the same thing. Increases in debt.
The negative government multiplier beyond a certain threshold. Yeah.
Absolutely. And that's really about, where we've got to. Once you get above 100%, there's a negative government multiplier. We're about 120% of debt to GDP. But this was the interesting thing. His whole argument, he based his whole argument at the end on Japan. He says, take a look at Japan, right? They have, this 250% of debt to GDP, and look at them. Yeah, let's look at them, because they can't generate economic growth. They have rolling recessions on a constant basis. Their interest rate is 0.95 right now. It's less than 1%. They cannot generate inflation. They're having their government central bank own 80% of the government debt and about 80% of the bond market. They're the only buyers of debt. They have a huge demographic problem, which, by the way, so do we. I just put this tweet out this morning, excuse me, on Twitter. This is the change in households from 1960 to 2023. So the number of households with unmarried partners, roommates, or adult relatives are now 16% versus 8%. They doubled. And again, this is children living at home or parents living with children. So multi-generational families. Single parents have gone to 7.4%. Married parents have fallen from 44% to 18%.
God, look at that. Yeah.
Single, no kids, 13% to 29%. Married, no kids, 30, basically staying at 30%. That's the demographic problem that Japan has. Now, Japan's about 30 years advanced into where we are economically. They have a huge demographic problem. We have an aging population with not a lot of younger generations coming up, and they don't have a very high birth rate. They have a huge pension problem, same thing that we have. They have tremendous amount of debt to deficits. They're again 250% versus 120%. They're just advanced about 30 years. So if you're going to use Japan as an example, it's a great example of what happens when you have too much debt. You cannot have inflation, you cannot have interest rates, and you have rolling recessions in the economy, very slow rates of economic growth. And that's the future that we're looking at, because we are emulating Japan on just about every front, whether it's demographics, finance, debt, etc. So, again, I thought it was an interesting thing that he went into, because, that's just not really the problem. It's actually the exact opposite problem that he's pitching, is that, this is going to be an issue, going forward, but it's actually just the opposite. It says that what's going to happen is that interest rates and inflation are going to fall. And that's why there's a huge demand for JGBs, because we buy JGBs to basically short the Japanese yen. And we use that as the carry trade here in the US. And that's ultimately going to be our fate. At some point down the road, people will be buying our bonds to effectively short our dollar, in theory,
Wow.
right? If we get to
Right.
that level.
So, but basically, look at Japan. Japan's stuck in deflation. You're like, yeah, that's what I'm expecting more of, or
Yeah.
disinflation. Yeah.
And then the same thing again. Go talk to Lacey Hunt. He'll tell you exactly the same thing. But so Jones's assertion is that the debt's going to be unmanageable. But see, debt rollovers are a standard practice for governments with large fiscal borrowing needs like we have. And the U.S. Treasury regularly, issues new debt to refinance old debt. And one thing we've been doing over the last couple of years, a good example, is that we've been issuing a lot of very short-term debt because rates are high. So the government's betting on lower rates going forward, because they're saying, look, I'm going to issue short-term debt that's going to mature in a couple of years, and then I'll refinance that into long-term debt when interest rates come back down again. That's also why the Fed's cutting rates. So, as this kind of goes through, and as the Treasury regularly issues new debt to kind of refinance maturing obligations, they spread the repayment cost over time. And so historically, that even when debt levels rise temporarily, they can stabilize that through economic growth. They can moderate inflation. They can work through fiscal adjustments to adjust that. And in fact, there was a really good research paper out by a guy named Paul Goldsmith Pinkham, which he laid out the premise that higher debts do not actually inherently raise fiscal costs, and that's as long as the economy's growth rate is above the interest rate. So in other words, governments can kind of roll over debt without increasing the debt burden over time. And that's where we are. Our real gross domestic product is growing well above what the interest rates are. And so there's this spread that the government has to refinance debt with, as long as they can keep economic growth elevated. And that's been one of the benefits that the government's had so far. But just kind of just summing all this up, look, there's one other factor that everybody on this train, whether it's Paul Tudor Jones or Luke Roman or anybody else, going, oh, interest rates are going to go up. The Fed's not going to allow rates to go up. The Fed's still doing QT right now. They're selling bonds, so that's keeping bond prices somewhat suppressed, because they're selling billions of dollars of bonds every single month. But
Well,
at some point,
sorry, let me just correct that. They're not really selling the bonds. They're just letting them roll off the balance sheet, right?
right. And well, they do sell some if they're trying to hit a target every month. So
Okay, but they're also buying. I mean, they still are buying too. Yeah.
correct.
But
But
net, they're mostly reducing by letting stuff mature.
correct. And we've reduced about half of what we bought already during the pandemic crisis. So the point is look, the Fed has one job at the end of the day, and that's to protect the banks. So if interest rates go up, we just went through this with Silicon Valley Bank. If interest rates go up too much, you're going to impair the collateral of all the financial banks in the country. All of a sudden, their financial stability comes at risk. At some point, the Fed says, we've got to get rates down. They cut rates more aggressively on the short end. They reinstitute QE to start buying bonds on the long end, and they start pressuring rates to go down. so the Federal Reserve, the central banks will step in to moderate interest rates. The government can moderate fiscal interest rates through fiscal policy. And again, at the end of the day, central banks, not just domestically, but globally, all have the same problem. And they have low economic growth, rising inflation, and they can't let interest rates go up too much because it just makes the situation so much worse. And this is why you're already starting to see central banks go back to injecting liquidity to try to bring economic growth up and suppress interest rates at the same time. So again, you're going to see this problem, as the economy, global economy, continues to kind of deal with this burden of debt that they have, is that it's continuing to press down on economic growth, which makes this all a much bigger challenge of having higher interest rates.
Okay. All right. Well, look, I'm glad we got to let you lay that all out on the table here. I got to move on because we're after the hour here.
Sure.
Can we get to the point, Lance, where we're pulling up the S&P and going through the latest TA? While you're doing that, I just want to note, I think at some point it would be really good to really dive into the demographic outlook for the U.S. and the other world major countries, because you're right. I mean, everybody's hurtling towards Japan. In fact, the country that's probably getting there at the fastest rate, at least, is China at this point in time. But same deal in the U.S. Europe obviously has a rough problem with this too. And I hadn't seen your chart there, and I had to write down, boy, in 1960, 48%, so almost half of the population was a parent, right? Was raising children. Now it's down to just 25%. So it's been cut more or less in half in several decades.
Yep. Well, yeah, I mean, and again, this is married parents, right? And
yeah, I included single too.
Yeah. And just it is quite amazing that, and again, I blame a lot of this on social media and things that we've done really since the turn of the century, where a lot of this stuff you can see really started to kind of, it's been trending over time.
Yeah, well, it's massively correlated too with women entering the workforce there. You can see back in the 80s is when it really started. Yeah,
it is exactly. But again, there's been so many changes to kind of the way that my parents grew up, kind of coming out of that post-depression World War II era. They were very nuclear families. It was pretty much you get married, stay married, and we've done a lot over the last 30, 40 years, 50 years, to kind of erode those kind of more moralistic standards that, our parents and grandparents grew up with. And we've seen this, kind of this off the rails movements that we've had over the last few years, where again, it's, more single parents, and just, I don't want to have kids because, it's the me moment. It's all about me. I just want to do stuff for me. But, we just forget how important that, raising and rearing children is, not just for having a family, right? Which is incredibly important. It's kind of the meaning of life in a lot of ways. But it's extremely economically important. And this is to your point about China. They killed themselves with a one-child policy. That they had this view, one child per family. This is going to be great. It's going to solve all of our problems. And then they realize, decades later, what a terrible mistake that was.
Yeah. So look, I agree with all this stuff, and this is so multifactorial, and I also want to be very conscientious of the fact that it is a lot more expensive to raise a child in real terms today than it was as well. So it is more challenging.
But that's relative, right? I mean, my dad never made more than $30,000 in his entire life.
No, I get it. I want to get into the nuances of this, because part of the discussion is like, look, people at most points in human history had it a lot harder than we do right now, right? So I want to put some of this stuff up on the board and then kind of deconstruct it. But again, it's
great.
That deserves a lot more space than we have right now. I just wanted to flag it. Sure. All right, so let's see here. So we are. Is this I see here we are, which moving average are we tapping right now?
We're sitting right on the 20. So
20, okay.
So just again, we had this, here's the day after the election. And we've just basically given all that back up. So, we're back to where we were when Donald Trump got elected into office. So here was the night of the election, the day after the election. So, but again, we had this huge deviation from the 50-day moving average. So now we're coming back down. We're testing the 20. If the markets can hold this 20 here, bounce off this, which wouldn't be surprising, we'll kind of set a new trend for the market, kind of this upward bias trend. It's very possible we come down and retest the 15 here, but somewhere between the 20 and the 50, I'm going to be a buyer adding equity. I am watching the short-term sell signal. So if we do crack this and create a short-term sell signal, it's not necessarily in the world. We've had short-term signals that don't necessarily, mean anything. Just gives you a period of kind of some consolidation in some cases. Sometimes it doesn't mean anything. But we are close to triggering a sell signal from a fairly high level, which could suggest a little bit more kind of corrective action going into next week. Which again, that wouldn't surprise me. There's going to be nobody around next week. It'll be inmates running the asylum into basically Thanksgiving. You'll see. I would after 2 pretty good days of selling here, I wouldn't be surprised to see a little bounce, a day or two in the market. Market sells off a little bit more, and then once we get past Thanksgiving, we get a rally into early December.
Okay. All right.
And then a rally at the end of the year.
Got it. And I think I asked you this last time, but let's just talk about it real briefly. The old expression that gaps get filled, right? You see that massive gap after the day of the election, right? So in some ways you could say, okay, this is the market coming back down to fill that gap. We can see here over the past 2 days, there's another gap that's opened up on the way down. So if we went down, bounced off that blue support line, and then rose back up to a new high, we would fill all the gaps, correct?
Yeah. And again, that really wouldn't surprise me at all. Money flows are negative right now. As I said, you had this big rally on declining money flow, which kind of told you that wasn't going to stick a whole lot. But this will turn. We got really overbought. We're kind of working that off right now. So again, it's just short-term volatility right now. It doesn't mean a whole lot. Today, again, we've got this really massive options expiration day. But again, kind of all signs point to the fact that we're going to get a bit of a rally into year end. And my target was 6,000. It was funny. I put out a tweet early last week, and I said, "Well, we hit my target of 6,000. So, what do you think the next? We don't change our target. We're going to stay at 6,000 through the end of the year. Then we'll set a target for next year." But I just tweeted out. I said, "What do you think the target is for the end of the year?" And 50% of the votes came in. There was almost 1,000 votes. 50% were 6,200 by year end. So there's a lot of very exuberant people right now in the market.
Okay, so I'm glad you used that word exuberant. We're not going to have time to talk about it in detail this week because we're going to start wrapping up. But you recently wrote a piece called "Exuberance. Investors have rarely been so optimistic." So to the extent that there's room to explore that more fully, we can do that next week, Lance. And I guess I'll hold for that conversation as well. I know questions that folks are holding on to. One is, hey, is the dollar overbought here, right? Because the dollar's had a really big move post-Trump trade. You're nodding as I'm saying this. Bitcoin, is Bitcoin overbought? I mean, Bitcoin has been on fire. You're nodding even more vigorously here that's likely overbought.
Dollar's very overbought. Bitcoin's very overbought. Gold is very oversold. So, I told you.
And that's where I was going next, was gold. Very oversold. Okay.
Right. So I told you we run a portfolio. It's called an all-weather model. We sold. We took profits in our gold position. We have about a 9% position weight in gold in that particular model. So we actually took profits on that about 3 weeks ago, which was, it's just simply because gold was so extended and so overbought on a monthly basis, weekly basis, et cetera. The correction was inevitable. And so now that we've had this correction, there's still the potential that if this dollar stays stronger, you could see gold retrace back towards 2,300-ish. So again, there's potentially a little bit more downside here, but gold is getting now oversold enough on a short-term basis for a decent tradable entry point. Bitcoin is super overbought. I'd look for a pullback there. All you need some news that everybody's betting on that the Trump administration is going to deregulate it, and just allow Bitcoin to go crazy.
Well, and create the strategic national Bitcoin reserve and all that
I
stuff.
don't think any of that's a realistic possibility, but we'll see what happens. I mean, look, anything's possible. But it's so overbought that just any little piece of bad news, you'll get a decent correction in Bitcoin prices. And again, if you want to add some Bitcoin to your portfolio, just wait for correction. You'll get one, and then you can add some. I own Bitcoin, so it's I'm not just saying that. I wouldn't buy it here. I wouldn't buy more today either. So, but on a pullback, sure. Same thing for the dollar. Dollar's had a huge run. The dollar's very, very overbought. So again, I would look for a bit of a pullback, which should actually, if that occurs, again, that should kind of correspond with a pickup in gold prices.
In gold, right? Yeah. Okay. All right. And look, if we want to go through the charts of that stuff, we can do that next week. All right. Well, look, we've already done your trades, so we don't need to do that here. But just a reminder, if folks are coming in here late, he made two notable trades in the past week. One is adding to your AbbVie position after the stock took a hit, and then beginning to get kind of initial positions nibbling into IWM because you expect small caps to do better under a Trump administration.
Yeah, and be real careful. Look, the reason we're using IWM is that about 40% of small cap, mid cap stocks are non-profitable. You have to really know what you own. There's a lot of risk in that small and mid cap space, and I don't run a small mid cap portfolio. We run a large cap portfolio. So we're just using an ETF just to take advantage of a technical move potentially in that market.
Right. You're capturing the beta of this sector. Yeah.
But if you're investing in small cap companies, be sure and do your fundamental work. There's a lot of those companies that are at risk, and they're particularly at risk if you're on the boat of Paul Tudor Jones thinking interest rates are going higher. There's a huge risk to small and mid cap companies, which are very economically sensitive and very interest rate sensitive. They've got a big debt wall coming up. So really make sure you know what you own in that small and mid cap space if you're buying the individual stocks.
Okay. All right. Good morning. All right. Well, look, in wrapping up here, I've got a little bit of a rant I thought it'd be fun to talk about. And this is more on the positive side, but it is based in our conversation from last week of looking at the agenda of the incoming administration on a relative basis, highly disruptive, right? Like, on the Spinal Tap amplifier, this is an 11 compared to previous administrations coming in terms of we're going to break things, we're going to do things very differently. And you already made mention of the Department of Government Efficiency that now officially Elon Musk and Vivek Ramaswamy have been appointed to run. I think Trump feels like he's got a clear mandate to come in and shrink government, and obviously Elon and Vivek have been very passionate about that. So you've basically given the two guys most passionate about this topic the keys to the kingdom. So I think we can expect that they're gonna make big moves, right? And I think, for a lot of people, big change is hard to imagine, right? Because we've always done something a certain way. Like really transformative change is oftentimes really hard for the mass audience to get and really even to believe in until it happens. And what I want to talk about here, Lance, is, sure, in terms of this new department, but really just more in terms of life. There's that old expression where there's a will, there's a way. And it's very true. It's once you, or in many cases, a impassioned change agent gets it into your mind or their mind that something that wasn't thought of as possible is possible. Once your mind accepts that, okay, this thing is possible, I'm going to take it on faith, and you shift into the, okay, so how do I make it happen? Oftentimes, innovation and creativity and just giving your brain permission to believe it's possible lets you find a way to make it happen. And look, there's probably no bigger, example of this than the moon landing, right? But there's all sorts of examples of this throughout human history, right? Building the pyramids 5,000 years ago, it certainly must have seemed like an impossibility before they started, right? But even if you don't, for those folks that don't believe the moon landing actually happened, right, Lance? Um, we've got examples like Roger Barrister's 4 Minute Mile, right? For all of human existence, it was believed to be just a physical impossibility that a human could run that fast, right? Roger Bannister beat it, right? Ran the first sub 4 minute mile. And then just 46 days after he hit it, Australian runner John Landy broke the time as well. And then within the next 3 years, 15 runners broke it, right? And it was all because their brains told them, oh, I thought it was impossible, but now I think it's possible, and therefore I can do it, right? Elon himself has actually, sort of shown the world recently what's possible when he took over X, right? And basically said, all right, 75, 80% of you, you're gone, right? And everybody said, there's no freaking way you can run a company that large on a skeleton crew like that. And of course, Twitter's still around today on many metrics, performing better than it ever has. So I bring all this to kind of raise two big questions I'd love for you to react to, Lance. One is, if you're watching this, as Lance and I talked about earlier, we've got people coming in that believe this type of disruptive change is possible, and they're going to go for it. So you need to ask yourself, okay, am I ready for this disruption, right? Because like Lance, you and I, we did an X space the night of the election, right? We had a viewer call in and was concerned about her job because she worked in a government agency that could, be cut, right? And we both said, hey, sorry to say, but yeah, you should definitely be planning a contingency plan in case, your department, gets declared redundant here. So I think, a good question every viewer should ask ourselves is say, look, if this type of disruption is coming, how vulnerable, if at all, am I to this? And then what do I maybe want to be doing now to come up with a plan B, rather than just putting your head in the sand and saying, there's no way they can do this because it's just too big of a task, right?
Yeah.
I think the second question everybody should ask themselves is, what disruption could my life benefit from? Like, what are the things in my mind I'm telling myself I can't change or are impossible to change, that if I just shifted that thinking and said, well, maybe I should blow some of these obstacles up. Maybe they aren't permanent obstacles. What ones could I target that could make my life an awful lot better? What big truths do you think that you could embrace that right now your brain is telling you, that could never happen, right? And I think people do this all the time in jobs or relationships. They say, look, I can't leave my job because I have all these obligations, but I hate it. If you can just look at that and say, well, what if I blew up my job, right? Would my life end? Probably not. And, I'm a living example of, having been, a corporate wage slave forever, thinking that I couldn't survive outside of that world. And I finally decided to blow it up before I knew what I was going to do next. And it was actually the decision to blow it up and realize, okay, that safety net is no longer going to be there, is what forced the creative thinking that then led me on this journey with, now I run Thoughtful Money and feel like it's, my reason for being in the world. And my wife, who's a therapist, sees all this happen all the time with couples too, who are stuck in a relationship, a marriage they don't feel they can get out of for reasons X, Y, or Z. But if they finally tell themselves, well, wait a minute, what if I just change the dynamic here? What could happen, right? If this is not a healthy dynamic for me, if I just put that in my laser sights and went after that, what could be possible? Yes, it'll be awkward. Yes, it'll be rough, but maybe there's a much better, existence on the other side of it. So anyways, Lance, I'd love to get your thoughts on this, either on the coming disruption that we're probably likely going to have economically, markets wise, et cetera. Or I know you've got your own examples of kind of blowing things up in your life that were obstacles in a good way, right?
Well, no, I mean, it's interesting. In this past weekend's newsletter, we were actually kind of writing about, this idea of disruption and, and what it means. And this is Invesco did a really good analysis of past presidents, and their point is that when presidents come in, they talk a lot about policy. They're going to do a lot. We're going to change all these things, and really, when we go back and look at time, there's not a huge percentage of real substantive bills that get passed in a congressional term. And going back to, basically 1956, the level of spending in the economy in terms of, how much businesses spend versus how much government spends versus how much consumption is done, which is your three major drivers for economic growth, really hasn't changed a whole lot. So despite this idea that we're going to come in, we're going to blow everything up and start over, it runs into a couple of headwinds. First of all, what can you get passed? And
Yeah.
and again, there's some things that he's talking about doing, like this Department of Government Efficiency. Can you just set that up, or do you need it needs funding? So you're going to have a congressional bill to fund the Department of Government Efficiency because they need money to operate. So you got to get that passed Congress, right?
Right. I mean, they've got to be given legislative authority, I imagine, so that people have to do what they say they have to do.
Right. So that's what I'm saying. So that may be a little bit more difficult to do than just saying, oh, we're going to do this. And I'm not saying it's impossible. I'm just saying I think we've got to temper our expectations a little bit. Another thing, other things that are coming on, like he just appointed Robert Kennedy as head of Health and Human Services. Well, he's got to be approved. And so you're going to have to get him by Senate, which, yes, there's a Republican majority in the Senate, but if there's just one or two guys that don't, or ladies that don't like, that are Republicans in the Senate that don't really like Robert Kennedy, or maybe they're kind of just sort of conservative, but they actually kind of lean more liberal in terms of a lot of their views, and there's a few of those. It only takes a couple of those to not approve his appointment. So that doesn't happen, right? And so we don't get this big radical reformation of health and human services that we're talking about. So my point is that, there's a lot of and again, there's also one other point that you were talking about earlier. We were having that conversation on election night about just, coming in and terminating a bunch of employees. You can't really fire government employees that easily.
Yeah, it's hard.
Yeah, it's very hard. And typically, if you're going to terminate a position, you've got to offer them a position somewhere else in government. So, and so my whole point is that there's a lot of talk right now about things we're going to do. And I think a lot of these are really good things. Some of these can be done with executive orders. Some of these will probably get passed, and some of them won't. And what that eventually looks like over the course of the next couple of years, I really don't have a clue. But one thing we are fairly certain of is that the level of things that drive the economy probably aren't going to change much.
Okay. And I think that's good. That's a good temperance to all this, which is, yeah, maybe don't expect everything to be different right away. But let's just for a second, I was curious to hear your reaction more on the Roger Bannister side of things, which is like, we talked earlier in earlier videos about like stoicism and the obstacle is the way. And I think this is kind of a version of it where you say, you know what, something that my brain wasn't allowing me to aspire to. If I just consciously say, well, wait a minute, let me actually challenge that assumption and let me make that aspiration. A lot of times you find a way to make it happen.
Well, yeah, but that's every business owner ever, right? I mean, it's just anything.
I think kind of, I guess my point is like every business owner still can get better at it, right? Like, we all can take stock and say, wait a second, what in my mind is limiting me here? And let me target that thing. Yeah.
Well, I posted this, I was busy on Twitter this morning.
Sounds like it.
Yeah, I posted this really.
Do you even work?
Yeah, exactly. And never this where I spend all my time on Twitter. But no, this was I thought this was a really interesting chart because I'm on my kids all the time about social media, and this was a survey of half of American teenagers spend 4 hours a day on their screens, and that's a lot of time that you're spending looking at a phone, and you're not really doing anything productive. So what I have a conversation with my friends, with my children about, and yes, I spend a lot of time in front of a computer all day long, but I'm researching, I'm reading, I'm writing, I'm processing, and I'm
tweeting clearly.
Sorry, and tweeting
clearly.
But but I spend maybe 15 minutes on Twitter in the morning. I post a few things, and I don't touch it for the rest of the day, generally, unless I'm doing this with you. So my social media time is very low because I don't find any value in social media. And where I find value is researching raw data and coming to my own conclusions and listening to what other people say and saying, okay, great. Do I agree with them or I don't agree with them? If I don't agree with them, why don't I agree with them? And then make sure I can back that disagreement up with data and facts, right? So, that is a productive use of your time. And what I tell my kids is that, look, if you want to be successful in life, that's 4 hours of your day right
Right.
there that you could be reading a book on how to be a better business owner or how to be a better entrepreneur or how to be a better salesman or whatever it is, or reading or going to the gym and working out, or you know uh, you know looking at your diet and reforming your diet to be healthier. There's 4 hours a day. There's only 24 hours a day. You're sleeping 8 of them in theory. 4 of them are going to looking at a phone. That leaves you 12 hours a day to go to a job and be productive, right? So, if you really want to succeed in life, you've got to put in the time. There's the old saying, it takes 10,000 hours to be an expert at something. So if you want to be really good at something, you've got to dedicate 10,000 hours. Well, if I'm spending 4 hours a day looking at a screen at pictures of cats and goats and things like that, that's not working towards my 10,000 hours of building an expertise in something that's going to generate better wealth.
Right. Right. Now that's such a great point. I got to say, Lance, I have trouble believing the data on that chart only because I think it's higher.
Look, it probably is higher, actually.
Yeah. All right. Yeah, I think it's a great point. And that's really one of the main reasons why I wanted to have this conversation was for everybody, but particularly for the younger people here. We get comments from younger folks that watch this, Lance, saying, hey, this kind of dad advice is really helpful. Not everybody gets it. And that's one of the things that I want to, challenge, but also encourage folks with is, we oftentimes feel limited by our environment, and it just takes like a shaking or a breaking of our conventional thinking that oftentimes opens up doorways of sometimes extreme possibilities. So to your case, right? I mean, if you were to tell the average 18-year-old right now, you got to not look at your phone you got to limit your phone time to a half hour a day or even an hour. I think they would say, no way. I couldn't live with that, Lance, right? But there are a zillion other things to do with your life. And obviously you and I know, because we grew up in the pre-digital era, that life works just fine without a device, surgically connected to you 24/7, right?
Yeah.
And interesting. Go ahead.
I was going to say, have you ever seen the movie Ready Player One? I've talked about
Yeah.
it with you.
Yeah. Which is the natural end game of all this, right? Yeah.
Well, yeah, it was interesting, in the end of that movie, they basically turned the internet off one day a week so people could go connect in real life. And it's interesting, you look at China, they are limiting screen time for their population, and they can only be on their phones so many hours a day. And a lot of their data that gets pushed out is all education stuff, increasing their education, math, science, STEM learning, etc. So, just, think about, what it would mean to our society if you just basically on Tuesdays and Thursdays, social media was turned off. Right. And there was no access to social media on Tuesdays and Thursdays, or Tuesday,
right.
pick it up,
Right.
whatever.
I'm having trouble hearing you over the screams of the libertarians, but I'll entertain this for a little bit. Yeah.
But my point is that all of a sudden, if it's not there, you have to go fill your time with something else. And, that could be going to the gym, eating better, whatever. Right. But I mean, it's just, there's clearly a problem with social media, and there's nothing good coming out of social media in terms of the impact on the economy. There's nothing really good coming out of this. So the question I think we all have to ask ourselves at some point is, what do you do about that? Because it's not leading to a good end game. And we've already been through the fact, teenage suicide rates are going up, depression rates are skyrocketing, blah, blah, blah. And all that directly corresponds when Facebook went public.
Yeah, I think everybody watching is on board with the fact that social media is net toxic.
I agree with you. People, if you tried it, I mean, look at all the angst people had over banning TikTok. It didn't even happen, right? But you had the entire country melting down over banning TikTok. So, I don't know. I don't have a solution for it.
Right. But we know
Well,
components, like as we talked about. I mean, again, I'm making a prediction here, but I think we're going to see more of what's like we're seeing in Florida, right? Which is like there's going to start being age limits on social media, right?
yeah,
It'll be treated just like, a driver's license or alcohol or whatever, right? And who knows, maybe your idea will come true. I mean, you and I grew up in the era of test screens, right? Remember, you'd turn on the TV
yeah,
too early in the morning and you'd get the test pattern, or at night the
yeah.
American flag would come on, and that was it for TV for the day. Maybe they start doing that on some of these. Who knows?
Who knows? Yeah, but again, like I said, I don't have an answer at
Yeah.
all, and I'm not really proposing one. But I just, again, going back to our conversation, if you want to build wealth, if you want to be successful, it's always interesting that the emails that I get from people that are like, oh, you're just privileged and this and that. Hey, I get it. I understand. But you don't understand that I lived out of my truck for 3 years.
Right.
I have been absolutely butt ass broke, and I just made a decision a long time ago that I was not going to live that way. And I dedicated all my time to building a business and have continued. And look, and I've had tons of stumbles and falls along the way. I've lost tons of money. I've had businesses not work the way that they were supposed to work, but that's just all part of that learning process. And the only difference between me and somebody else was I just didn't, I'm too stupid to quit. So I just keep going forward.
Well, yeah, I mean that's the self-effacing way to say it, but you had the perseverance and the grit, and again, that's one of the reasons why I like for us to have these discussions, because we're both guys who bootstrap themselves. It's to hopefully give people the sense that this is all possible. And look, I don't want to downplay the crushing weight of being stuck in a bad situation, especially if you're in an economic hole, you don't feel like you got a lot of marketable skills to leverage. It's a rough place to be, but you can get out of that, and that's one of the reasons why I talk a lot about this. And you made one comment I just want to briefly address, and then we'll wrap up. You said, oh, you could use that time, instead to read books and whatnot. And I totally agree that that is a great use of your time. Now, I think a lot of younger people who just didn't grow up reading as many books as you and I did, Lance, might be
Yeah.
like, oh yeah, okay, boomer, whatever, I'm going to start reading books, right? And my point on that is, hey, you should read books. But I think what Lance is really saying is you should find ways to use your time constructively and productively. And a big part of that, especially when you're younger, is to learn, right? So that you can build skills, build mastery, build expertise to be able to then command a premium, in the job market, or just do more of the things you want to do in life and enjoy life that way. And my point is I'm taking, I've got to take continuing education credits. Lance, you probably do too, right? As a financial advisor, they make you take a certain number of these things. And it's reminding me something that I learned when I was in college, which is I'm actually not great learning from a textbook. There's something about the density of a textbook that honestly just puts me straight to sleep. I can read articles on the internet all day long, but really I learn from talking with people. This is a much more effective learning mechanism for me and how I'm wired. And so, all right, look, you don't want to read books? Great. Go find people who are smart and knowledgeable about the things that interest you and talk to them, right? There are all sorts of different ways to do this than, the one way that maybe you find the most boring or whatever, right? So there's lots of different ways to skin this cat about absorbing quality information and applying it. So I'll let you comment on that, Lance, and then we'll wrap up.
No, I mean, I grew up and when I was growing up in our house, again, we didn't have phones, right? We had encyclopedias and National Geographics. And so every day my dad would sit down and we would read the encyclopedia, we would read National Geographics, and that was what we did. We didn't watch TV. We would sit and read National Geographic, or we'd read, an encyclopedia. And then we'd watch Gilligan's Island from 7 to 7:30. So, but yeah, it's just, we grew up in a different time, unfortunately. There was a great video. This dad has his son locked outside the house, and the kid's maybe 8, 9 years old. And he's like, the kid's begging to get back in the house. And he's like, Dad, I want to come in the house. He's like, what are you going to do if you come in the house? He says, I want to watch YouTube shorts. He's like, no, stay outside. He says, there's nothing to do out here. He says, go find a stick and do something with it. but that's the way we grew up. It was a stick and a ball. You had all the entertainment you needed. But you know, it's just it's a different time. But I agree with you. You're an auditory learner. I'm a visual learner. I have a hard time like you reading textbooks, but I learn very quickly by seeing somebody else do something or somebody showing me something. I can learn that very, very quickly.
Yeah.
So, or if somebody's presenting something and writing it on the board, I get that super fast. But I have a really tough time sitting there reading a textbook because I'm kind of like you. I just follow. I find I find I'm reading stuff 3 and 4 times. Like, where was I? Oh yeah, I got to do that.
Right, right. But I know people that is their
Yeah.
preferred way to absorb information.
Yeah.
So the point is for you individually, folks watching this, determine what are your best ways and focus on that. Don't push on a string and get an encyclopedia and feel like you have to read the whole thing. And if you even know what an encyclopedia is these days, I don't think they make them anymore. But yeah, the point is there's there are many different ways to get to where you want to go. Find the pathway that's best for you and plays greatest to your strengths. All right. Well, look, and wrapping up here, folks. If one of the ways you find the most meaning in life is listening to Lance Roberts on this channel week after week, please let him know that by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. Very importantly, if you want some help, especially with this end of year planning, like I said, go get the checklist that you can get for free off my Substack. If you decide you want some help in implementing that, send it to your existing financial advisor if you've got one and say, hey, am I good on all this stuff? But if you don't have a good advisor already, or if you'd like a second opinion from one who takes into account all the things we talk about here on Thoughtful Money, maybe even Lance and his team there at RIA, then consider scheduling a free consultation with one of those advisors by going to thoughtfulmoney.com, filling out the short form there. Again, these consultations, the minute you fill out that form, these advisors will be in touch with you to schedule a time. And again, do it sooner rather than later because time is ticking to get all those things done before the end of the year. While you're there at thoughtfulmoney.com, don't forget to go up to the top of the page, click the newsletter link. That's how you can sign up for our Substack for free, or you can just go to thoughtfulmoney.com/Substack. All right, Lance, thanks again. Another great week. I'll give you the last word as usual.
Nope. Just sit tight. Again, it's going to be weird trading for the next week or so as we get into Thanksgiving, and then should be better Black Friday, right? So things should be getting better after that.
All right. Well, however it is, we'll touch base on it next week. I'm going to be doing this one remotely, Lance. Next week, I'm going to be at the New Orleans Investment Conference. So I'll be taking this from the hotel room. I'm going to be interviewing or moderating a panel there with a lot of great people, including Danielle DiMartino Booth, Peter Schiff will be on the panel, Lawrence Lepard, a few other folks. So I'll probably have a lot of interesting stories to tell from that. But anyways, Lance, like I said, great week. Thanks so much for putting it all on the playing field as usual. Everybody else, thanks so much for watching.